Cheers, Bryce.
Oh, wow. Cheers, man. Oh,
Different opening.
nice. Different opening. I don't mind that. That's a lot better.
Yeah, I don't know why we need to do this then. But
True. By now, we should
another
know that it's working.
another afternoon beer discussion. No
With,
beers again.
again,
I put the blame mostly on my housemate who is drinking all of our beers during lockdown. So,
peace. Look,
but you go.
no, it's okay. It's all right. You go.
This is a problem with not editing, but this is going to stay in.
Yes. Yeah.
But for people who are new to the video, excuse that and stick with us. We're here to talk about one topic in investing or finance or to do with money that has taken our interest over, it should be a beer, but let's say a drink.
Yes.
And the rules of this are when we finish our drink, the conversation's over and we go our separate ways.
That's right. So we are Equity Mates Investing Podcast. You'll find us at equitymates.com. So Ren, both with a red wine in hand, and I must say I'm pretty pleased with the drop that I've chosen for today. Just letting you know. But we're not here to talk about our wine. We're here to talk about stocks, and we usually open with a question. And I know you have one burning, ready to go. So
I do.
How about you let rip?
It's been an interesting few months in markets. There was a big crash, and then a lot of companies have recovered pretty strongly in the last month and a half, 2 months almost now. But in the last 3 months, there are still 8 ASX200 companies. So of the biggest 200 listed companies in Australia, there's 8 that have fallen 50% or more in the last 3 months. And so my question to you is, which of them would you invest in? But
well, I mean,
just in case you don't know what the company is.
Yeah, I'm not a mind reader.
Yeah. I'm getting to that. I'm going to ask the question.
How about I guess all 8?
Oh, that would be impressive.
No. You go. Hit me.
Okay, so the 8 are Southern Cross Media, Ardent Leisure, Kathmandu, Flight Centre, Uniball, Rodamco, Westfield, Media, Credit Corp, and Virgin Money UK. Some names that people are probably familiar with, a lot of names that people may not be familiar with. We're going to unpack them in this video, but I'm going to start with the question again. Of those 8, gun to your head, if you had to invest in one, you can't say, I don't want to invest in any stocks that have lost half their value in a quarter of a year.
Why not?
Which one would it be?
So a few interesting stocks there. They kind of fall into a few genres. We've got advertising. We've got sort of financial services or in that financial industry space. We've got retail, both property and also, I guess, clothing. And knowing my love affair with retail, Ren, for those that aren't aware, I do love a good retail stock. And I feel like you've thrown that one, Kathmandu, in there. It might not even be down 50%. You just thrown it in there.
I can tell you, it's down 56% in the last 3 months, but it's up over 100% in since its lows in the last 2 months.
Okay, so without not knowing that,
you know that now.
I do know that now, and it strengthens my argument. Not an argument, my point of view. I would be choosing Kathmandu as my investment choice, gun to the head.
And
I know
why?
that. Look, I think we're seeing restrictions being eased over in New Zealand and Australia, both 2 regions that obviously they get a fair chunk of their sales. I think it's a very strong brand that has had a bit of a turnaround of late since we were sort of back at uni. They were struggling and have really done well to change their business model and focus on retail and on online. And I think that's a really positive thing. And I know that it's trading at a really cheap PE ratio, price to earnings ratio, somewhere in the 4s. So it seems like
sixes, maybe, I think.
6s. Okay. So it seems like it's a pretty good bargain at the moment, without going too much under the hood. I think there's a lot of upside given where it is at the moment. So that would be my choice.
Nice one.
Yeah.
I think its online business is, I think, less than 10% of its overall business. But yeah, you're right. It has had some good growth in that area. The first one of these videos, we actually spoke about Kathmandu, I'm pretty sure.
Yeah, it rings a bell.
And yeah, my thesis on Kathmandu, I don't own it, but I feel like it's one of those retailers that is a little bit immune from the online disruption. Similar to your Bunnings or your supermarkets, I feel like it's one of those retailers that people will want to go in to touch and feel the items. To not so much with supermarkets, you're not asking for expertise of the people working there, but with Bunnings and with Kathmandu, I feel you want to feel the tent that you're going to buy, try the boots on, speak to the attendant about what the best sleeping bag is, stuff like that you can do online, but
who goes into field tents to buy? No one.
You get in it, you zip it up, you're like, could I sleep in this?
No one does that.
Some people do that.
I get your point.
Some people do that.
I get your point, but I think if we use those examples, particularly supermarkets, we've seen that online penetration for sales has drastically increased over this period of time, given that not a lot of people are able to be out and about. So I wouldn't be surprised if, whilst their online sales were a small percentage before all this happened, that they'll come out of it with a much greater percentage of online sales. So let me take that as a note, as I always do.
I was going to say, this could be a whole separate episode, because I don't think I agree with you, but I don't want to get bogged down in your favorite topic, which is publicly listed retailers.
All right. Well, let me throw it back on you then, Ren. So we had Southern Cross, Ardent, Kathmandu, Credit Corp, Virgin UK, Flight Centre, and Westfield. There was one more.
Media.
One that I've actually pitched and we'll get to soon.
Yeah, I was that was gonna come up in this conversation.
So of all of those, where would you be putting your money if you had the gun to your head?
So there's two that I think are interesting, and Kathmandu is a third that I think is interesting. A mate of mine was talking about it when it was about 60 cents, and he put some money into it, and at this point, has not almost doubled his money, but has done quite well on it. So Kathmandu is an interesting one, but I'll take a different answer to you. So the first one that interests me is Credit Corp. Now, for people who aren't familiar with the business, they essentially buy debt from banks and other lenders, and then chase that debt on their behalf. And, they buy the debt for less than it's worth from the lenders, and then try and recover the full amount from the borrower. And they make their money on that spread. Now, they've been punished because while there's a lot of debt being taken out at the moment, there's a lot of, moratoriums on foreclosures and stuff like that. And there's a lot of government money propping up businesses that are indebted. So Credit Corp will probably take a short-term hit on the back of that. But I think of the 8 companies we're talking about, only one of them has had double-digit revenue growth over the last 5 years, and that's Credit Corp. Mm-hmm. So I think they were pretty strong beforehand, and there potentially will be some nice tailwinds for them after this pandemic is over, and the government assistance sort of eases off. There'll be a lot of businesses that will have had to take debt to get through this, and potentially that bigger pool of debt will mean that they can pursue higher quality opportunities. And so over the medium term, potentially Credit Corp is an interesting one. So that's number one for me. Number 2 is Uniball, Rodamco, Westfield.
Yeah.
Now, for people who are unfamiliar with this stock, it was created when Westfield's non-Australian holdings merged with a European company. And they own a bunch of shopping centers and the like overseas. And a big reason they've been smashed is because Europe has been smashed by the coronavirus, and a lot of their shops have had to shut, or a lot of their tenants have had to shut, and that's affected their share price. If they can get through it, they're an interesting stock for a couple of reasons, but I'll just talk about one. If they can maintain their current dividend, it's yielding 13%.
Wow.
Yeah.
Wow.
And that's a big if. They probably won't maintain their dividend.
Highly unlikely.
But, if there's a quick recovery and they don't slash it to the ground, it's potentially still an interesting dividend to take advantage of.
Yeah, it's interesting that you talk about dividends. It's something that you need to be wary of in times like this, because not all businesses have updated their, or have expressed what their dividends are likely to be during the next reporting period. And so it's very easy to look at stocks at the moment based on current dividend yield, or based on what it was when they last paid out. So it's more just a buyer beware situation. But
I think on that point as well, it's the same argument as with PE, price to earnings ratio. Everyone's looking at, Kathmandu with a 6 PE, and some of these other stocks. I think they're all in the single digits for PE, for price to earnings at the moment. But even if the price doesn't move from here, the earnings more than likely will, and that will broaden out the PE again.
Yeah, it's a good point. Like you though, Ren, my second stock was Westfield. I think, they're quite a strong company, global, but we know that commercial real estate is going through a very tough time at the moment. The reason I want to keep an eye on it is just I think it's going to be interesting to see how these big players move through this transition of knowing what to do with commercial real estate. Like, whilst they're not all retail, they own a lot of real estate in terms of offices and that sort of thing. And we know that there's a potential for the dynamic to change from businesses needing offices to house 5,000 people to needing offices to house potentially less than that, as more and more people work from home and look for flexible working options. But these buildings are going to remain. So it's, what are they going to creatively do to attract new business to these sorts of places? So I'm keen to see how that plays out.
I mean, forget what we're going to do with all this office space. Even before the coronavirus, the question about what we were going to do with all this retail space was a big one.
Yeah.
Like there's whole shopping centers, there's, main streets full of retail shop fronts that no one really wants.
Yeah.
So it'll be a interesting one. There's I was reading an article today. Apparently there's a heap of cash on the sideline in the commercial real estate sector. So obviously a lot of smart money thinks that sector, there'll be a delayed impact, which makes sense. Leases are long-term obligations a lot of the time. So they'll take some time to shake out. But apparently there's a lot of cash on the sideline trying to take advantage of some cheap real estate in the coming months or years.
Surely at some point the government should do a smart thing and rezone some of these areas. You look at, around here, Oxford Street in Sydney, and you look at areas of King's Cross and down through, parts of the city as well. And there's just empty shop after empty shop, but in areas that people would love to live. And if you just rezoned them or did them up and made them into, small livable units, it's something that they could take advantage of. But anyway.
It's a good call. Lobby your local council.
Yeah, well, maybe we should buy up. Equity Mates should invest in all these properties.
Yeah.
So that leaves 6 companies that we haven't spoken about, or 5, but maybe we should go the other way.
What would we short?
Yeah.
Yeah. All right. Well, you kick it off. You kick it off. So they've already lost half their value. Some of these companies have lost more than half their value because we're only looking at the past 3 months here. Which of these do you think have further to fall?
I think if things stay the way they are from a social distancing point of view, it's hard to look past Ardent Leisure outperforming from here. And
So Ardent Leisure, for those who are unfamiliar?
Ardent Leisure owns theme parks, and they are also involved in main event entertainment, which is a large portion of their revenue. Essentially, that's those big sort of complexes you go to that have the bowling alleys, the ping pong tables. You can buy a few drinks, get some food, and have, you know, that arcade game-esque type fun, I guess, if that's your thing. So as
you had your birthday party there recently, didn't you?
yeah, 29th birthday party. Yeah. So I think if social distancing rules do stay, hey, there's your housemate who drinks all the beers.
He's probably sneaking off to get more beers now.
You didn't drink it. What are you talking about?
I can't see theme parks becoming a thing again for a number of years. I can see a resurgence somewhat in the bowling alley and whatnot. It's probably easier to do social distancing there than it is in.
Were they big before though? Like, were they big profit centers?
I mean, for Ardent Leisure, they're a significant part of their revenue. So if shit turns south with them, then yeah, it's not going to be good. I think my point is that I can see upside on a number of these other companies, and I can see where they will come out of that recovery period and start to, I guess, get back to the way things were. I think fundamentally, though, Ardent Leisure's business model is under a lot of pressure at the moment.
Yeah, I tend to agree with you, but I do have, I guess, a devil's advocate case for why Ardent Leisure could actually do okay out of this all.
Is this a realistic one or a blue sky?
There's a very strong caveat, which is for the last 3 years pre-coronavirus, Ardent Leisure lost money. It wasn't profitable for the last 3 years. So there's bigger structural issues at play rather than just the coronavirus. The coronavirus has just really magnified some of these issues. But let's put that to one side and just talk about the coronavirus. Potentially, hear me out, potentially, if international travel restrictions are in place for much longer than we expect, if the coronavirus is ripping around different parts of America and Europe and Asia, and it's taking a while to contain, meanwhile, Fortress, Australia and New Zealand is keeping their borders shut and staying coronavirus free, you could see a scenario where there's a heap more domestic tourism, like domestic travel, because people can't go overseas. And potentially Ardent Leisure is a big winner in that situation, because if you can't take your kids to Disney World in Florida, why not take them to Dreamworld on the Gold Coast?
Because Dreamworld on the Gold Coast sucks.
Oh, look, I'm not saying I think that's going to happen, but I'm saying
riddle me this. If a family are in a situation where they're fortunate enough to be able to take their kids to Dreamworld in wherever, Japan or wherever it is, in America, why would they not be taking their kids to the beautiful landscapes of New Zealand overseas instead of going to trashy Gold Coast? No offense for anyone who's in the Gold Coast.
Look, I'm going to defend the Gold Coast here. No, I think
I can understand what you're saying, but I think that they're going to be limited with how many people they can still allow into these parks. So
yeah. So that's the second thing. So one would be there's no international competitors for tourism. So there's a captured market. And even if more people choose to go to New Zealand, they don't need to capture everyone that was going overseas. They just need incremental growth. And then I guess the other thing would be, do they use social distancing as an excuse to massively readjust their pricing and
they would
bring
have
that
to
supply and demand curve back into equilibrium at a much higher price point?
Oh, but it's a catch-22. You raise the price, you scare people off. If you don't raise the price and you were unprofitable before COVID, then you're going to be even in a deeper situation. with less people coming in at the same price, you're going to be digging yourself into a hole.
Look, let's not get too far down the fixed and variable cost discussion, but I think there are ways where if they have less people and they reduce their variable cost, but they charge each person more, potentially it's a better business model as long as they can't drive away demand, as long as they're still filling capacity. But then, and to bolster capacity, they've got all this extra domestic demand. I'm
marking
I
you
don't want to
down
die on this
here.
hill.
I'm marking this down as we go. So far, Bryce Ardent Leisure is S for short. Ren is L for long.
No. Okay, don't get me wrong. I'm just making the bull case. You've got to be able to argue both sides. Otherwise, you shouldn't invest in the stock.
But who would your short be?
Good question. So Southern Cross Media, for those that are unfamiliar, runs radio stations. I'm sure they have other media assets, but they're big on radio stations. And as we know, podcasts are absolutely eating radio's lunch.
Oh.
We're taking their listeners, we're taking their advertisers. Southern Cross Oz Stereo was in a lot of trouble before coronavirus.
Yes.
And they're going to keep being in trouble afterwards.
Yes.
Podcasts are here to stay. Radio's going.
Yeah, they've been a bit of a I would say dog shit company for a while now. Yeah.
Tell us what you really think.
To your point about revenue and radio, I think they also have a number. Now, I could be really wrong here, but I have a feeling they have a number of outdoor advertising I guess, opportunities that they sell as part of their model. And we know, and I think this is potentially why Media are also in this bottom 8. We know that outdoor advertising at the moment is not very attractive to advertisers, given the considerable reduction in foot traffic and also commuting, people on public transport. Those assets, you think billboards, you think the outdoor plasma TVs, bus stations, these sorts of outdoor advertising is just, it's done for the moment until we get back to sort of full potential of people traveling again. So I have a feeling Southern Cross are involved in that. It's in some way.
So Southern Cross also have TV properties. I'm pretty sure regional free-to-air TV properties. And I don't know about you, but I've been locked in the house for the last 2.5 months. And I reckon I've watched free-to-air twice, and it's been through their apps.
Yeah.
You know, like through iView.
Sorry, what's free-to-air? What's free-to-air?
It is just not competing. So yeah, I think the radio thing, obviously I was a little bit sensationalized there, but the long-term trend in free-to-air TV and radio is that advertising is shifting. And you're right to the outdoor advertising point as well. It's here to stay, but marketing budgets are getting slashed, and there's going to be less foot traffic and public transport commuters and stuff like that. So advertising businesses are going to hurt for a little while.
Big time.
I don't actually think OO is in as much trouble in the medium to long term as this share price reflects.
No, I agree.
Outdoor advertising isn't going anywhere until we go full, lockdown, or, we glue our phones to our head or something. Like, outdoor advertising will always have a place. But geez, I would not want to be invested in the public radio or free-to-air TV sector at the moment. And that is probably killing some relationships that we want to keep warm as we grow this podcast. But, that's my honest opinion.
Yeah, no, I agree. I think Media, look, I pitched it on a mastermind way back when. And I think what really captured me with that stock was the fact that they were able to, through use of technology and big data, actually able to provide some pretty interesting insights back to the companies that were using their assets to advertise. To your point, Ren, it's done and dusted for the moment, but at this share price, there's certainly a longer term opportunity there as people and communities start to come back to the way things were. If that ever happens, who knows? But
Now,
yeah.
I've almost finished my drink, but I want to get your thoughts on one of the other stocks before we wrap it up, because we asked this question this afternoon in our Equity Mates discussion group. Facebook.com/group/Equity Mates if you want to join. But there's a lot of love for Flight Centre, especially at the price that it currently is at. I'm interested to know your thoughts on that stock.
Look, it is trading at a cheap PE, price to earnings, but as we mentioned, not always, something to live and die by, given what's going on. They have done a capital raising. They're obviously in a fair bit of trouble at the moment, but I think they've been a market darling for a while. And I don't necessarily see it being as impacted as people have first made it out to be. Of course, international travel is one of their big sort of areas of their business, but if they can focus in on the domestic market for now and really provide a good service to the customers that loved using it, your retirees and those that really wanted to have an agent to look after their travel and really hone in on the Asia Pacific and New Zealand when these borders start to open up, I can certainly see a recovery happening a lot faster than perhaps the share price reflects at the moment. Yeah, that's my thoughts. I'm neutral on this stock at the moment.
Fair enough.
What do you think?
I've just so I used to own Flight Centre back when we were at uni. It was probably one of the first stocks I bought. I'm pretty sure I lost money on it, and then it went up afterwards. But the thing that, looking back and looking at the stock now, I just am not convinced by is that it has any defensible moat. And I really want people in our discussion group to hear this, jump on the group and tell me what the moat is, because you could say things like its store footprint. You could say things like its level of service. You can't really say price, although it does have a price guarantee. There's nothing. Yeah, go on.
My guess for this would be that it is probably the most, if not equal to the most well-known travel agency brand in Australia. And that in itself is somewhat of a moat. Everyone knows Flight Centre. Brand power is certainly a moat. That would be my argument to that.
Yeah, I guess for me, there's brand moat and then there's brand moat. And
they're not Google.
Google I wouldn't say is a brand moat, but I would say Nike is the classic example of a brand moat, where people are willing to pay more to buy Nike products. So their competitors, Puma, Adidas, Under Armour, they can compete on price. They can try and compete on quality. But the fact of the matter is, as long as Nike is Nike, people are willing to pay more, sometimes for shitter quality because it's Nike. Flight Centre is known, and I take your point, and it's a fair point, but is that a brand moat in the same way that Nike has a brand moat? Like, if Flight Centre weren't offering you the better price, you wouldn't stay with them because of their brand is my point, I guess.
Yeah, it's a fair call. I think, without going too deep into this, but I really can't think of another bricks and mortar travel agent other than Student Flights that I would go to if it was bricks and mortar. And maybe this is where they're going to come unstuck in some way. But it's an interesting one.
Yeah.
So you're unsure.
No, I'm not short on it. I think the price is compelling. I think the unit economics of the business. I haven't looked at it since I sold it, but the unit economics of the business I seem to think were compelling. But there's a strong tailwind in the fact that, and this is why I bought them back in the day, that boomers are retiring en masse. They're selling their stocks, cashing out their superannuation, and they're going to want to travel, and they're not going to want to book through Google Flights on the Mondo. They're going to want to speak to someone, get it planned out, and Flight Centre is going to benefit from that tailwind. And you're right, they're the best known travel agent. They've got the best footprint. They've got the most presence across Australia. So there's a lot of reasons to like them. But for me, I just can't quite understand what's protecting them from a better travel agent taking their lunch.
That's a fair call. I'm looking
but I
forward
want
to seeing
people
what their
who
reaction
are
is in our
investing.
group.
Yeah, because there's a lot of love for the stock, and a lot of the
There is.
love for the stock comes from the price. The price alone shouldn't be why you're investing.
Yeah.
So I'm interested to hear people's opinions, because by no means am I an expert, and by no means am I right. So this is part of the journey.
Nice one, Ren. Well, that was a good chat over one glass of wine.
Yeah,
you're done.
We didn't even cover all the stocks, but I think we've had our fill. We've chatted some stocks. And,
yes, absolutely.
If people want to pick up the conversation, they can find us in the discussion group.
Yeah, head across to Facebook, Equity Mates discussion group. Again, you can head
Facebook.com/group/Equity Mates.
No one does that. Who does that?
I do that. That's how I find the group.
Oh my God. You obviously don't know about the side links. But anyway, otherwise you can find us equitymates.com, or we'll be in your podcast feed, Equity Mates Investing.
We're everywhere.
Yeah, we're bloody everywhere. You'll see us on outdoor advertising because no one else is buying. So we bought them because it's really cheap. Anyway,
all right, Bryce, until next time.
Good to chat.